Hey everyone, I'm Jun, a researcher with DXY. The DXY, or should I say the US dollar, holds the title of being the most traded currency globally. Let's delve into what 2024 has in store for traders dealing with the DXY. Let's start today's episode with the chairman of the Federal Reserve, Jerome Powell, who is likely pleased to see a decrease in inflation alongside a resilient economy. The Core Personal Consumption Expenditure Price Index, which is the Fed's preferred measure, only increased 1.9% on a 6 months annualized basis based on the Bureau of Economic Analysis data. Additionally, the Cleveland Fed estimates for the quarterly annualized percent change in the fourth quarter of 2023 have dipped below the Fed's mandate, although a rebound above 2% is anticipated in the first quarter of 2024. Now, this estimate is seen as favorable for the Fed. Investors' optimism for a robust year for US Treasury has received a boost with indications that the Federal Reserve might consider slowing the wind down of its balance sheet. In the recently published minutes of the central bank's December meeting, some officials proposed a review of the policy of reducing its balance sheet, commonly known as quantitative tightening, or QT. Lori Logan, the president of the Dallas Fed and former head of the New York's Fed market desk, highlighted the rapid decline in the use of overnight reverse repo facility as a reason to reconsider the policy. We can see in the records as well, money in the reverse repo is dwindling fast. If the Fed pivots and contemplates reducing rates from the current 22-year high of 5.25 to 5.5%, it could potentially bolster treasury prices and mitigate volatility in a market impacted by a surge in supply. The Fed, who have been the largest buyer of US government debt in recent years, began trimming their balance sheet from $9 trillion in May 2022. Aiming to address the most significant inflation surge since 1980s. Following massive interventions during the initial stages of COVID-19, with inflation concerns seemingly more manageable and rate cuts on the horizon, some policymakers, as reviewed in the meeting minutes, are open to discussing the circumstances under which the quantitative tightening plans could be revised. Analysts like Joseph Abate from Barclays interpret this as a potential step towards ending QT. An end to QT would have the positive effect of reducing the amount of debt that the Treasury needs to issue to private investors this year. A survey by the New York Fed conducted in December among Treasury dealers indicated that major banks were anticipating the Fed to conclude QT in the fourth quarter of 2024. So, besides concluding quantitative tightening, it's important to note that the Federal Reserve is planning to decrease interest rates to counter the impact of reduced liquidity once reverse repo activity diminishes. I won't dive into the specific rate predictions since I've covered that in last week's episode, but I've mapped out the expected trajectory of US interest rates probability on the US 2-year yield chart, based on data from Bloomberg. From the looks of it, there's a gradual and slow decline anticipated, likely remaining within a certain range by the end of 2024. This is in line with the Fed's preference of staying higher for longer. The strength of the US dollar in the past was backed by a combination of the US economy outperforming and widening rate differentials, both in nominal and inflation-adjusted terms. Despite the ongoing strong performance of the US economy, a significantly altered interest rate landscape is predicted to result in a roughly 5% depreciation of the DXY. This estimate is based on the observed relationship between DXY and yields over the last 3 years, suggesting that DXY tends to move around 0.4% for every 10 basis point shift in the 2-year yields. Just bear in mind that the extent of the depreciation down the road will hinge on how quickly Federal Reserve ultimately opts to cut interest rates. The Fed yield-driven dollar rally has been a significant factor since the second half of 2021, extending into 2022 and most of 2023. However, the narrative began to shift late last year due to disinflation and mounting evidence of a US economy losing momentum. With the market adapting to the easing phase of the monetary cycle, the yield story is now turning bearish for the dollar. The shift in perspective is a key aspect of our bearish 2024 outlook for the dollar. The degree of downside, though, will depend on various factors, including the extent of Fed easing. Bloomberg Economics expect a 125 basis point cuts in 2024. How quickly and by how much other central banks ease? And crucially, whether a risk-on market context will prevail. From January to October 2023, the 10-year US yields climbed to a high of 5% from 3.35%, contributing to the Bloomberg Dollar Index gaining nearly 5%. In late 2023, a combination of a weakening US economy and a dovish adjustment in Fed rate expectations and a risk-on market context created an ideal scenario for dollar bears. During this period, risk appetite, especially evident in equity markets, re-emerged as a significant driver in forex market. In 2024, it is anticipated that risk will continue to play a crucial role in near-term forex movement, which is negative on the dollar, would benefit from an extended period of risk-on sentiment. However, this will hinge on various factors, including the economic and inflation landscape, earnings expectations, US politics, and geopolitical developments. Surprises in these areas may unfold throughout the year. The negative trajectory for the dollar that unfolded in the fourth quarter of 2023, attributed to dovish expectations from the Federal Reserve and set against a backdrop of decreasing inflation, resulted in a substantial depreciation, aligns with our prediction of a continued downside in 2024. However, it's crucial to highlight the adverse factors in the short term, fueled by signs of a weakening economy and disinflation trends in a risk-on market, may encounter challenges throughout the year. Similar to 2023, we shouldn't anticipate an exclusively pessimistic view on the dollar to endure, given the elevated levels of economic and risk uncertainties, along with a significant movement in the last quarter. It's wise to approach the situation pragmatically and avoid complacency in adopting a bearish stance on the dollar. Examining medium-term factors such as budget and current accounts position, they contribute to the downward pressure on the dollar. But on their own, they haven't been game changer. Meanwhile, the recent sharp decline in the spot dollar value were partly attributed by the significantly reduced dollar long positions. In fact, current positioning might suggest a potential for a near-term rebound. So, what implications does this hold for gold in relation to the US dollar? Now, let's keep in mind that correlation doesn't necessarily imply causation. Therefore, examining gold's connection to the DXY is just one of the factors I'm considering to assess the current situations. But I'll delve into more specifics. The late dynamics of 2023 painted a contrasting picture, gold soaring to a new heights while industrial metals experienced a decline, signaling potential global recessionary path. The burning question for 2024 revolves around the duration of these trends, and the forecast hints at a potential acceleration. The era of aggressive global tightening seems to have concluded, possibly requiring lower base metal prices to justify easing, hinting at the looming possibility of a recession. In 2023, gold ETF faced stiff competition from the surging US stock market and rising interest rates, resulting in a 9% decline in gold ETF holdings in ounces. Despite these outflows, the price of gold increased by about 12%, indicating divergent strength, especially with central banks actively accumulating gold. The crucial question is what might trigger a shift from outflow to inflows for gold ETF. The Federal Reserve pivot towards easing stance as a significant tailwind for gold. Another potential catalyst could be a bear market in equities, a common occurrence in recession. After the unprecedented global tightening, gold might perform due to its nature as a safe haven during times of risk. A modest retracement in the S&P 500, nearly 25% gain, would be the catalyst for gold to solidify the transition from 2,000 an ounce as resistance to becoming the support, while some Bloomberg strategists suggest a possibility of gold hitting 3,000 USD per ounce if the stock market falls. It does seem a bit ambitious to me. Looking ahead to 2024, if the US stock market remains resilient, gold might hover around 2,000 an ounce. On a personal note, I think even if gold price were to increase, it's likely to be a slow and gradual process, mainly due to the gradual fall in interest rates. It's crucial to remember that gold is a non-yielding asset. In an environment where treasury and investment-grade bonds still offers attractive yields, investors might lean towards those options. But for CFD traders, choosing the right strategy is paramount, considering the factors as mentioned earlier. Thanks for joining me today. In the next episode, I will be doing a quarterly check on US banks' performance for the fourth quarter of 2023. Everything I've shared are informations that I've picked up and learned, sprinkled with a bit of my own takes on things. When it comes to trading or investing, do your own due diligence and be mindful of the risk. If you find this video helpful for your research, don't forget to share it with your friends as well. They might find it useful too. Quickly access to all of our channel by scanning the QR code. Take care, and I'll see you in the next episode.